The interview is live. Look at that. Hey guys, quick reminder before you enjoy today's episode. I do a lot of work in the descriptions below to timestamp when the founder gave me critical data points like revenue and they finally shared their customer count or their team size and valuation. So you can use those timestamps to click around. Also, I'm going out on a walk here while I keep rocking my lockdown beard and while we all wait for this nasty virus to go away. But I will be hanging out in the comments on my phone. I'll be looking for your comments and I'll be replying to all of you guys. So if you have questions that you want to ask the founder or ask me, you can put them below. I'll see them all. In the meantime, enjoy today's episode. Hello, everyone. My guest today is Mark Organ. If you're looking at him going, wow, he looks healthier and happier and more excited now, that's because he took the very drastic and maybe unconventional move of replacing himself as CEO at a company called Influitive, which he felt it wasn't the right time anymore. So he's built Influitive up to about $12 million in ARR, just recently replaced himself. Before that was the early founder at Eloqua. So lots of experience now doing a lot of founder coaching. Mark Organ, you ready to take us to the top?
Let's do it.
Come on, that was a good bio, right? Just for off the cuff.
I'm really impressed with that. Just right off the cuff, which is awesome.
So guys, the reason this is going to be a little different than most episodes. Okay, so Mark has built many SaaS companies, had a lot of success, but he's spending a lot of his time on founder coaching now. But we're also in the middle of this massive crisis, right? Recession, virus. So we have to tie all these things together. We're going to touch on all of it. Mark, I want to pose this first thing to you, which I think is very interesting and captures kind of not only macroeconomics but also social dynamics during this time. And it's the following. There's PPP. This will be released right after. We're recording this on Thursday, April 2nd. But in the US, the $350 billion stimulus funds basically open up and can be applied for tomorrow. And there's a big debate right now about a thing called an affiliate rule inside of this fund, which basically says VC-backed companies should not be applying for this money because they're not frontline restaurant workers that just got laid off. And then there's others going, yeah, but I had to lay off a bunch of my staff. I'm VC-backed. I should get some of the money. And there's a lot of people predicting that this stimulus is going to cause additional social unrest between the poor and the wealthy. And I'm curious to get your thoughts on if you believe that does happen. Does that become a storyline in the media? And if so, how should founders, think about this and communicate it with to their teams?
Wow, there's a lot in there.
Yeah.
I do think that anytime the government's coming out and giving a whole bunch of money to some people and not other people, you have the opportunity for unrest and for a lot of social pressures to come up. I mean, we've seen that in history. I would say that as a founder, if you have an opportunity to get cash from the government at this point, I try to do it. And you're certainly going to pay enough in taxes over your lifetime. So if this is your one opportunity to get a little bit, then sure, as long as it's not too onerous and having to fill out a huge number of forms and everything else like that, which I think could take away from.
So let me make this really real for a second. Let's say Influitive did this, right? Let's say Influitive went. So the way you calculate it, by the way, for anyone listening, is you take all your payroll for US based employees over the past 12 months, ignoring contractors, capped at $100,000 per employee, right? So if you pay someone 200 grand, you only count 100 grand. You take that number, divide by 12 to get it monthly, and multiply by 2.5, right? So if you had $1 million in payroll, divided by 12, it's 83 grand a month, times 2.5, you're eligible for about, what is that, $200,000 in government stimulus in the US. So Mark, imagine a headline 2 weeks from now on CNN. VC-backed San Francisco company with 30 million, right, in VC dollars gets $200,000 check from government bailout. What does the restaurant worker and the laid off kind of person in Kentucky, when they read that headline on CNN, think about that big VC-backed company that just took advantage of the stimulus dollars?
Look, I think we're in survival mode right now. And so at this point, I'm thinking less about the restaurant worker in Kentucky, and I'm thinking more about how do I make sure that my company survives this? And my rationale here is, look, when I get through the other side of this, I'm going to be employing 3 or 4 times as many people. I'm going to be generating, hundreds of millions of dollars, if not billions of dollars in value for my customers who are going to be more successful because they're using my software. So actually, I feel quite justified in this case, especially because I'm going to be spending, in the tens of millions of dollars over my lifetime paying taxes I think that it's okay to get a little bit of help in a challenging time. So I think that's okay. Even if that was a headline, I think I could justify that in saying, hey, look, this is a tough time for everybody. The restaurant business is not actually one that is sustainable. That doesn't sustainably create lots of high tech, innovative jobs. Whereas I think what I'm doing does. So I know that might sound selfish, but I don't think it is. I don't think it is, because I think those of us that are in venture backed software companies, if we're building valuable software, we are helping our customers, which are other companies, become more profitable and making them more successful. I think that's more important than, serving food, personally.
Good answer. Let's dive into this a bit more, right? So you're working with SaaS founders now. The economy really started crumbling, at least in the States, really worldwide, obviously, about 2-3 weeks ago. For a SaaS founder that you're coaching, who had raised a couple million in VC, who is maybe burning $200,000 a month, and they only had maybe $1 million in the bank, right? So 5 months of runway. What advice were you giving them a week ago?
Yeah, no, and that is absolutely the case for a number of my clients. So the first thing is we need to build strong defense, right? It's very difficult to innovate and figure out new products and services for growth until we know that we have enough runway. And it really depends on the situation. There's one of my clients where she really wasn't able to let go of people, but she was able to get them to work for a 4-day week instead of a 5-day week. And that was able to save a lot of jobs and is keeping the business running.
But so she pays them maybe only 10 or like 30 or like 80% of their usual monthly salary?
Correct.
Okay. So furloughed, basically.
Furlough. Yeah, it's a furlough, but as opposed to like going a week off at a time, you're going off. So there's a rotating schedule where every day there's a, if she's got 80 people in her company, there's 16 people that are off on a Monday. There's 16 people that are off on a Tuesday, and so on. I was pretty smart, actually, and she got a great response from her employees, who are happy to still have their jobs. And they have a day off a week during a weekday where they can prepare and deal with maybe future stuff that might come down the pike. So it was pretty innovative. Another one of my clients did let go, did a 30% riff, was going to do a 20% riff. I encouraged him to think deeper. And instead of saying, okay, here are the number of people I have and who may be expendable or in this time or redundant, what I encouraged was to start from literally employee one. So I'm employee one, the CEO. I'm the first employee. Who else do I absolutely need? Okay, I need someone in finance. Okay, I need one person in marketing, whatever. So build up from the bottom instead of come down from the top. So that instead of doing a 20% riff, he actually ended up doing a 30%, which actually is better. It means that there's more runway. And my experience with this before doing layoffs is that you'll find out pretty quick what is really essential, and you can always hire that back. Particularly now, it's not hard to hire back now in this time. There's a lot of people available. So that's another one. And yet another person, opened up an employee stock ownership plan available to everybody, and encouraged everybody to buy stock with their compensation. And a lot of people did.
Okay, wait, that's interesting. I hadn't heard of that before. Let's break that down. So first off, give me some context without naming the company. Is there some, have they raised VC, and if so, how much?
Yes, they've raised 22 million.
Okay, and how many total team members do they have pre-virus?
So pre-virus, this is a bigger company. So pre-virus, this was 320.
Okay.
And now it's a lot lower, but not a lot lower. So they, cut 40 people. So there's 280 people.
Okay.
Making it available, and he encouraged, I encourage you to spend 20% of your comp on stock, right? It would be great, but made it optional. There's some who bought a lot more. This company's actually doing really well. There's an opportunity to be a unicorn, I think, in the next 4 or 5 years.
Well, hold on. Let me run this down, Mark, because I think people are going to want to copy this, because I think it's an interesting model. I'm going to make some, again, granding generalizations for a second for the sake of getting more specific. Let's say they've raised 20 million. They've maybe done it over many rounds, but let's say like the last round valuation, I'm going to make this up, was something like 100 million, right? So they raised like 15 on like 85 pre, right?
Probably not far off.
Okay. Let's say it was that. Did they just, so then now they have to come up with a price of which the employees can use what would have been their cash comp to basically get awarded those shares. 2 questions. Did they use the last funding round price? Number one.
So the answer is yes, but I think that they could have come up with a much lower price, which is something that I did. So at Eloqua, when we were really in trouble after 9/11, and we had 4 months of cash left, I did something similar, where we, together with the board, decided on a pretty low price for the stock because it was after 9/11. There was no budgets or whatnot, and we came up with a pretty arbitrarily low price. I remember it was 10 cents a share, which was a nice round number at the time. And we probably valued the company at something like $2 million. And basically everybody in the company bought stock. That's where I got the idea from, right? It was my own experience. Everybody in the company bought stock. A number of people's parents and relatives and whatnot all bought, not just because they believe in the company, but they want to keep it alive and keep their kids' jobs.
Yeah.
But that extended our life from, we had 4 months of cash remaining, and it extended from 4 months to 9 months. It was actually a really big difference.
Because you cut burn so much, because they, instead of paying out cash, they were using that would-be cash and you're just awarding stock, basically.
That's right. And so we gave a lot of stock. And as a result, there's, a number of, there are some pretty junior folks at Eloqua that are, made $10 million plus when Eloqua went public. And that's because they got so much stock during this time when we were in real trouble, which actually is great. I love that.
So back to this current example, if all the employees agree to buy stock, what percent of the company has this company dedicated to this program specifically for the virus? 10% of the company, 5%, 20%?
I can figure that out. And it's still ongoing. So we don't know how much stock they're going to buy. I don't think I don't think the CEO's put a limit on how much they could buy. I think in the model, he had something like $2.5 million worth.
I guess the reason I'm asking is because typically, like in these funding rounds, the VC that put in the money will also require you to top up your employee option pool, usually 10% of the company. And I'm just curious if he went and got approval from the VC to expand that option pool, or if he's just taking the unallocated stock that he hasn't given to like new hires and basically using that option pool to put out to current employees if they buy that instead of taking cash.
Yeah, it's not part of the option pool. It's not options. They're buying shares.
Okay.
They're buying common shares.
Did he have to go back and get approval from the VCs? Because they're obviously getting diluted. Everyone's getting diluted.
Yeah, but the VCs are happy to do it.
Interesting.
Well, it also strengthens the company, right? And that's really what happened too after, when at Eloqua, when the employees bought all the stock, was they really were owners at that point. And so it built a very strong and resilient culture. So I think smart VCs are always really happy when employees own more of the company, especially if they're paying for it.
Yep.
The big difference between getting awarded a bunch of options that have an expiration that can, they have to be redeemed within 3 months after leaving. I mean, those are much more ephemeral. Whereas no, these guys are card-carrying shareholders. They're going to show up to the annual shareholders meeting. And they're on the same playing field as all other investors.
So let me try and put this in 2 sentences, put it in a bow for the audience and you confirm if I articulate this correctly. This VC-backed company, okay, with about 340-ish people, had to cut down to 280 people. They still wanted to save some additional cash flow. So what they did is they've raised 20 million in venture capital. Last round was called 85 million. They raised 15, so 100 million post money. They've basically dedicated $2 million of company valuation in terms of the shares to dole out to current employees, the 280 that left, if they chose to take those shares instead of getting paid cash for salary. That total amount is $2 million on the 100 million. So basically there's 2% of the company they're leveraging during this crisis to give out to employees who take that equity instead of cash.
Beautiful. Yeah,
that's it?
That's exactly right. Yeah.
Okay.
And actually, I think that's one of the best things that you could do at this time. Again, you strengthen the company, you raise more cash, the employees are super motivated. So it's a good move. So those are three different ways that my clients have got themselves more runway. And
what's enough, by the way? You said at the beginning, everyone needs enough runway. What is enough right now?
Yeah, that's a good question. I would want to be able to buy a minimum of 9 months. So I think in 9 months, most good founders and CEOs can figure out how to get their company profitable. And so 9 months to me is the absolute minimum of time that you need, and it's exactly what I did at Eloqua after 9/11 was buying to 9 months, and also putting a plan in place now for how are we going to be profitable and cash flow positive after those 9 months.
Does 9 months assume a little growth, no growth, or a churned assumption on top line?
It really depends on the company, right? So, I've got one client where he's going to assume negative growth, that he's not going to add any new clients, and he's going to customers, and he's going to lose a bunch. But then actually most of my customers are still selling. Actually, they're still growing, still selling. You're probably seeing that with SaaS companies like that. That is continuing. But with assumptions on selling a lot less, and the churn. So typically what I'd say is that churn is going to go up by 10 points. So if you're used to 20% churn, that might go up to 30% churn. And your new sales growth is going to be, pretty anemic in terms of ARR. The way that I've got my companies profitable for when I need to, and how I'm coaching my clients, is to cut way back on partners and focus on doing a lot more services in-house. So I think services is really a missed opportunity for a lot of SaaS companies.
Well, it's lower margin, so they try and outsource it, right? Because their VCs say we want high margin SaaS only.
Exactly, right? And maybe that makes sense when you're growing 200% a year and whatever. But right now, it's all about survival. And especially when your customers themselves are letting go of people, there's myriad opportunities to understand how you can add more value. And so the way I'm approaching my clients is to spend more time with customers. Obviously, you can't go face-to-face anymore, which is unfortunate because there's a lot you can learn when you go face-to-face. But spend more time, especially with senior customers, and understand more in depth. Well, how are they using your software? What other software are they using? What are they using spreadsheets for? What are they using CRM for? And figure out what else you can do, because there's probably more that you can do. They're already comfortable, buying from you. You're probably, as an enterprise SaaS company, you are a market expert. You're an expert in whatever it is that you do. And so if you think of yourself more like a services company, and because now, it doesn't really matter what VCs think. What really matters is getting to cash flow positive and getting profitable. There's lots of opportunities to deliver services, actually pretty high margin, $200 an hour plus.
Yeah, product enabled service. Yeah, with the SaaS product they've built.
I think that's it. And even doing services. So, I went as far as doing services where I've not even sold my product yet. Mm-hmm. So, for example, there are a number of, today most companies do needs analysis for free. Right? Hey, I'm a sales rep. I call you up and say, hey, let me understand more about your needs, and I'll give you a proposal and whatnot. But that's a service that you're rendering. You're rendering needs analysis service. You're delivering a proposal service. You're just not charging for it.
Yep, charge for it. Good way to get cash in the door.
Mark, especially if you're really focused on a target market that you understand better than anybody else. If you're the expert, you can actually charge someone $10,000 to understand their needs in great detail and give them a proposal that they can then use they can hire you and your software, or they can go to your competitor
Yep.
but most likely they're going to go to you.
That's right. Hey, we're running out of time here, Mark, but I want to get one last question in. There's a lot of people that would say engineers, their payback is longer term than hiring a salesperson that can close deals today. So if you have a team and there's a founder listening right now with 10 engineers and 4 sales reps, and the engineers also usually cost more, and you have to fire 4 people, do you fire engineers or do you fire salespeople?
I would fire any salespeople that are not ramped because it takes too long to get payback. So my framework on this is that in a time of crisis, your cost of capital is enormous, which means that you need to get payback very quickly with a high level of certainty. So a new sales rep is going to be a very uncertain investment. It's going to take too long. So if you've got 4 reps and one of them's still ramping, cut the one that's ramping. On the engineers, if the engineers aren't working on stuff that is going to generate a payback within 6 months, then they need to be reallocated or they're gone. So that's what it's all about. It's all about how do I get payback within 6 months, and I want to get at least a 3 times return within 12 months. Now, normally for engineering, you're looking at a very different equation. Normally in engineering, you want to get a 20 times return on investment within 2 years. But this is a different time. And so like any Horizon 2 investments, okay, Horizon 3 investments in product, gone, right? So which normally Horizon 3 investments are the ones that actually generate the biggest return, but it takes a long time. It's very risky. So those are gone. Horizon 2, you really want maybe only one Horizon 2 investment that may be game changing for you, which means that Horizon 2 investment, you might want to get a 10 times return within 2 years. There's only room for one of those. Everyone else, I think, has got to be zeroed in on the current customers and doing whatever it takes to minimize churn. And with what do we need to build right now to win new customers in the door, especially things that reduce cost and risk for our customers. That's what they want to buy. They want to buy risk reduction. They want to buy cost reduction. So it may feel myopic and a short-term focus, but it's what we need to do to get through the crisis. And once you do that, you may be the only one left standing, and then you can invest in all kinds of amazing things that'll let you grow big in the future.
Guys, there you have it. Mark Organ, an Influitive founder, earlier founder at Eloqua, now coaching folks, CEOs. We talked about 3 things today. Number 1, how much runway you need to plan for. Number 2, how to cut costs to get to that runway, especially if you're VC backed and you are bloated and burning a lot of capital. Number 3, we talked for a good 5 to 8 minutes about specifically how to use your last round valuation or the company valuation to essentially give out stock in exchange for your employees using what you would have paid them in salary and cash and just awarding them stock. Saves you money, gets people more invested in the company, and can be good over the long run, just like Mark saw happen in Eloqua after the towers came down in 2001. Mark, thank you for taking us to the top.
Thank you, Nathan.
All right, guys, what'd you think? Enjoy the interview? If you like that one, a lot of data, be sure to click the little like button here on YouTube. And then additionally, coming up tomorrow, we have a founder revealing their valuation. The day after, we've got someone raising $100 million right now in the middle of the virus. How the heck are they going to do this? I don't want you to miss these interviews. So be sure to click my face right here and click the subscribe button to subscribe to the YouTube channel so you don't miss those new episodes. In the meantime, if you're looking for something else to do, I recommend you check out one of these 2 episodes for more data on SaaS companies. And if you ever want more data, just look in the description of the videos and you can click to getlatka.com where we have over 1,400 companies and all their revenue data, their churn, their CAC, their valuations. It's all there. It's like a much better version of the Inc. 5000. So check it out. In the meantime, be sure again to subscribe and then pick a video and interview to listen to next.